Hello, Super Saver. So, your 401k account is not SIPC protected, regardless of whether it's held with Fidelity, Schwab, Vanguard, or the like. At least not in the classical way that many of us think of SIPC protection. Up to $500,000 for missing securities, which includes a $250,000 limit for missing cash, if your account is held at an SIPC member brokerage firm. For many Americans like you and me, our 401k is our nest egg, where a good part of our life savings is. So I don't want you biting your nails watching the rest of this video thinking that some bad character can just simply wipe out your retirement savings, because hopefully they can't. There are laws in place to prevent this. They're just not necessarily under the purview of the SIPC, and they don't necessarily work like classical insurance. Rather, protection of your 401k account relies more on a trust setup with fiduciary duties and strict procedural and governance safeguards. And that's what we'll be talking about in today's video. 1, how SIPC protects a 401k and how it doesn't. 2, what and who actually keeps your 401k safe. And 3, the last high-profile case that directly impacted 401k reform. So, let's dive in, Super Saver. Many of the Diamond Nest Egg regulars have already seen this SIPC list on the different types of accounts that the SIPC protects if you hold these accounts at an SIPC member brokerage firm, such as Fidelity, Schwab, Vanguard, or the like. And as we can see, a traditional IRA and a Roth IRA are considered separate capacities. And each capacity is protected up to $500,000 for missing securities and cash, including a $250,000 limit for cash only. 401k accounts are not listed. And in fact, if we go to the SIPC's investor FAQs and scroll down, here's our answer. If your employer's 401k plan assets are held in a customer account at an SIPC member brokerage firm, then cash and securities in that account may be eligible for protection by SIPC. Protection is limited to the amounts available with respect to a single account, however, i.e. an overall limit of $500,000 for missing securities and cash, of which no more than $250,000 may be for missing cash. SIPC protection is not available separately for the individual participants in the 401k plan. Meaning, for example, if Diamond Nest Egg had 200 employees and we set up a single company 401k plan with Fidelity, that one Diamond Nest Egg 401k plan account may be covered up to the SIPC limit of $500,000 for missing securities and cash, of which no more than $250,000 may be for missing cash. The 200 individual employees who participate in this hypothetical Diamond Nest Egg 401k plan, however, would not be covered separately under the SIPC, but would all have to share that single $500,000 SIPC limit. And I did speak to a friendly SIPC representative named Hamant last week, who said he'd be subscribing to our channel, by the way. So Hamant, if you're out there watching, thanks for taking the time to answer the SIPC questions for the Super Savers here. Anyway, Hamant confirmed that the hypothetical Diamond Nest Egg example that I just described to you is the case in most 401k situations, but that it does depend on how your 401k plan is written. If there's only one single brokerage account for the entire company plan, there's just one overall protection limit, but no separate protection limit per participant, as we just said. This would only be different if your company was setting up separate 401k accounts with their brokerage for every single employee who participated in the plan. So in our hypothetical Diamond Nest Egg retirement plan example, this would mean if Diamond Nest Egg opened 200 separate accounts for the 401k plans for its participating employees, then and only then would every single account for every participating employee be protected separately up to the $500,000 SIPC limit. So, if any of you want 100% certainty, Your best bet is to check with your employer to find out if your employer has just one 401k plan account held at an SIPC member brokerage firm for all participants together, or whether they've set things up with the brokerage firm so that each individual employee holds their 401k plan account in their own name. And if you do end up doing this, please drop a comment below and let us know. As I just mentioned though, my conversation with Hemant seemed to indicate that it's generally the former and not the latter. Which begs the question, what and who actually keeps our 401k safe? Who and what keeps this country's roughly $6.3 trillion in 401k assets safe? This $6.3 trillion of 401k assets held in more than 625,000 plans, managed on behalf of about 60 million active participants and millions of former employees and retirees, because that's a lot of money. And the answer to this is ERISA. ERISA stands for the Employee Retirement Income Security Act of 1974. What's important to understand here is that your 401k plan is not insured under ERISA in the same way that your deposits are insured by the FDIC at an FDIC member bank, nor in the same way that your securities and cash are protected by the SIPC at an SIPC member brokerage firm. Rather, ERISA, the Employee Retirement Income Security Act, sets forth minimum requirements for the setup and governance of a plan, how your 401k plan should be set up and managed so that your interest as a 401k plan participant is best protected both against fraud and bad investment decisions. One of the most important components of ERISA is this. ERISA made it federal law that assets held in your 401k plan must be held in a trust. The easiest way to think about this is that when you make 401k contributions into your plan, that money is held in a trust that was set up specifically for this 401k plan. Similarly, any matching contributions from your employer also go into the same trust with your name attached to it. And those trust assets, your contributions in this trust, as well as the matching contributions from your employer, are separate from the assets of your employer, the plan sponsor, say a Fidelity for example, the plan advisor, if any, as well as the trustee or custodian. All the 401k assets are held in a trust exclusively for you and the other 401k plan participants, of course. It's the responsibility of the custodian or trustee to safeguard the assets in this trust and ensure that they are used for your benefit and for your benefit only, meaning that the money that you put into your 401k plan stays in there and is invested in the way which you've chosen to invest it. And equally important, that these other parties here or anyone else who shouldn't can't touch your 401k money. This trust setup also means that if your employer gets acquired by another company or goes through financial difficulty, or worse, bankruptcy, the trust protects the 401k assets from your employer's creditors making a claim on your 401k money. It's also good to know that if you, as a plan participant, run into financial difficulty, your creditors also can't make a claim against your 401k money. There are exceptions for family support and in some cases divorce, but that's a topic for perhaps another day. There are 4 other important ways that ERISA protects the funds in your 401k plan. 1. ERISA requires your 401k to provide you with important plan documentation regularly and automatically. This includes, amongst other things, reports on how the plan is doing financially, what your investment options are, what fees you're being charged, and so on. This helps ensure that you have access to the information that you need to make decisions about your retirement savings. 2. ERISA sets minimum standards for 401k plan participation, vesting, benefit accrual, and funding. For example, it details how long you might have to work before you're eligible to participate in your company's 401k plan, and how long you may have to work before benefits accumulate, as well as how long you may have to work before those benefits vest. Vested assets are yours to keep forever. ERISA also provides detailed funding rules to make sure that your company actually has enough money to pay for their portion of the 401k plan. For instance, if there's some sort of matching company contribution to your 401k plan. 3. ERISA makes sure the fiduciaries of your 401k plan act responsibly. Basically, that they act in your best interest. ERISA typically defines a fiduciary as anyone who exercises discretionary authority or control over a plan's management or assets, including your 401k plan's trustee or custodian, sponsor, and any associated advisors. Fiduciaries must follow strict standards of care and loyalty to 401k plan participants when they make decisions about the plan's investments and operations. And any fiduciaries who do not act in your best interests may be held accountable for losses due to misconduct. For example, a fiduciary needs to ensure that your 401k offers you a variety of investment options for diversification and risk management purposes, as well as see to it that fees and expenses are reasonable. And as I mentioned earlier, if a fiduciary is found to have violated their duties, they may be liable for damages. 4. ERISA gives you the right as a participant of your 401k plan to sue for benefits and breaches of fiduciary responsibility or other legal violations. There needs to be an internal claims procedure as well as the ability to bring legal action in federal court if needed. There are 2 additional noteworthy points to keep in mind about ERISA. And that's 1, ERISA does not require any employer to establish a retirement plan. It only requires that if your employer chooses to set up a retirement plan, then that plan must satisfy certain minimum standards, which we've already gone through. 2, ERISA does not protect the value of your investments. So if you lose money in your 401k because of bad investment choices made by you, market fluctuations, and so forth, ERISA will not protect you against that. But then neither does the SIPC. Now, let's move on to the last high-profile 401k collapse that made ERISA what it is today. Much of the governance and protection made possible by ERISA here was a result of the passing of the Pension Protection Act in 2006, following the high-profile failure of Enron's 401k in the early 2000s. Enron's 401k plan had been heavily invested in its own stock, which became virtually worthless after the company's financial fraud was exposed. The Enron scandal led to increased scrutiny of 401k plans and the fiduciary responsibilities of plan administrators, sponsors, and advisors. And one of the much talked about features of 401k plans, the often very limited choice of investment products available, must be seen in this context as an attempt to make sure there are no investment options that may be too unsafe or just even too adventurous for long-term pension savings. From what I was able to find, there haven't been any major 401k collapses since the Pension Protection Act was passed after the Enron debacle. And it also appears that ERISA has been doing its job as a regulator of 401k plans and is not seen as a toothless, all-bark and no-bite supervisor. In March of this year, professional social media firm LinkedIn settled a 401k lawsuit for $6.75 million. The lawsuit was filed by current and former participants in LinkedIn's 401k plan who alleged that the company and its fiduciaries were not ERISA compliant because the plan charged fees that were too high and offered investment options that were poorly performing. And towards the end of 2022, Wells Fargo settled a 401k lawsuit for a whopping $145 million. According to this Forbes article, Wells Fargo did not admit any wrongdoing, but the Department of Labor did reveal in its investigation that Wells Fargo employees overpaid for the company's stock in their 401k accounts between 2013 and 2018. All that being said, just because there hasn't been a major 401k failure since Enron is no guarantee that something like that may not happen in the future. But so far, for the past 17 years, since the Pension Protection Act was passed, it does seem that ERISA's strict standards and requirements around 401k plan governance and management has worked to protect the interests of 401k plan participants like you and me. So while our 401k accounts are not protected by the SIPC in the classical sense, we do have ERISA as the government watchdog overseeing the retirement savings in our 401k. Now, would I prefer a more classical insurance type protection for a 401k plan similar to what's offered by SIPC? Yes, 100%. But as we say in the industry, it is what it is. And given what it is, are we still investing in our 401k with its tax advantages and other benefits, knowing that under ERISA, there are strict rules for governance and investments, and that the trustees are subject to fiduciary duties and liability? Yes, we are, and we continue to contribute every month to our 401k. Listen, I wish there was more of a guarantee as well, along the lines of what's offered by the SIPC and the FDIC. But in this case, there just isn't much choice, at least not for our family, in my mind, if we want a tax advantage, automated way to save for retirement that also takes advantage of company matching benefits. What about you? What's your take on this whole thing? Drop a comment below for this curious cat and let the community know as well. And in case you want further information on ERISA, I've attached these ERISA FAQs in the description below, as well as the sources we've referenced in this video. And if you want to learn more about SIPC insurance for your personal investment accounts with your broker, then check out this video here to learn more. All right, Super Saver, I hope this clears up some of your top questions on how your 401k is protected and has helped to put your mind a little bit more at ease. As always, if you enjoyed this video, then don't forget to share with those you care about, and of course hit that thumbs up, and see you again very soon with another brand new wealth building video.